So that's just a fact when you have a short sale constraint. So what we do is we think about stocks that have some event, like high volume day or big price movement. In China, when you hit the price limit, either up or down, you end up on the news typically, or the financial wrap-up program. And then we look the next day at what individuals are doing. Are they buying the stock or selling the stock? And sure enough, on average, they're buying those stocks. So we pick a stock that has some big, it's a stimulus that will kind of make the news, make the financial program, and it seems to set off buying. And then what we're going to do is we're going to be even a little smarter. We're going to continue to think about days where like only a few stocks seem to hit the stimulus, like maybe 3 stocks or 5 stocks hit their price limit, versus a day when like 100 stocks or 200 stocks do. Now, if 200 stocks have a big news day, a market-wide event, that doesn't help the investor narrow down that bunch of stocks. You've got 1680, now 200 stocks have an event. I've still got 200 stocks to deal with. So we're going to expect more buying after days with concentrated events and few numbers of stocks, and that's what we see. On the x-axis is the number of stocks that had an event. So we just grouped them. So that's 1 to 5 stocks had an event today. And the next day, we see this buy-sell imbalance is positive and big. Further out, when 11 to 20 or 21 to 100 stocks have a news event, something like that, we do see some buying, not as much. And then finally, in market-wide events, way to the right, it's slightly negative, though basically 0. What's even more interesting, and I didn't want to try to plot all of this, but for these stocks on the left, when individuals go in heavily and buy, the price gets jerked way up on day T+1, and then it mean reverts slowly, and it takes about 10 days, so 2 weeks to come back down. But there seems to be a price distortion of about 3%, meaning if you're a long-term buyer, say you want to hold the stock for a year, or even a medium-term buyer, you kind of end up paying a 3% charge if you buy when everyone else is buying, because the price has gone up 3%, it mean reverts back down, and then it's kind of starts over. So you're just kind of pissing away 3%, to be a little crude about it. That's the cost of the bias, and it is distorting prices also. So basically, the individuals in China, again, they have a big problem to solve. They react to stimuli, buy en masse when there's a limited number of them, and we see the stock price distort. What's interesting, again, this affects people in many countries. In the US, there have been some nice studies. We have this big American football event, the Super Bowl. Okay, so Super Bowl's on Sunday night always, and if some company, I don't know, GoDaddy, runs a lot of ads, it turns out on Monday morning there's a lot of retail buy orders for GoDaddy. Okay, you didn't get any financial information about GoDaddy on the Super Bowl ad, and most people were drunk and not even paying attention. So it's not like they did any great analysis, right? It's just somehow there are a lot of stocks out there. They got this brilliant idea because the GoDaddy ad was good, and then they go out and place orders on Monday morning. The price jacks up. It's about 1.5% in the US. They lose that money, and then it comes back down. It takes about 3 to 5 days in the US. So again, as a financial advisor, this is really a behavior that mostly hits individuals. You would want to think about how to keep your client from coming up with bright ideas the same day everyone else comes up with the same bright ideas. So whether you go through monthly contribution plans or make sure that your advisor's not paid on turnover, whatever the case may be, you want to somehow break this cycle. Even waiting 2 weeks after your bright idea is a better plan. You'll make an extra 3% because of this price distortion. Just a quick note on gender before we wrap up. But in most studies, everywhere in the world, up until our studies on China, 80% of the retail investors are male. It was exactly 80. It was like 79.6 in the US and 79.2 in Finland and 78 in Israel. It's very surprised. And the ratio's changed a little in the US. It's like 70-30 now, instead of 80%. But in China, we see 50-50. In our data, it was like 50.1 and 49.9, which is quite surprising. given that they're, I guess, more men than women by some degree. But it was really 50-50. More or less some of the same behaviors. So both men and women exhibit home bias, which was interesting. The one difference that we didn't see and we're still working on is men trade more aggressively than women in China, but they also have more opportunities to trade. So you have different rights through your brokerage account. Can you place internet trades? Especially in the early part of the last decade, now everyone can do it, but that was a big right. Telephone trades. It's in the US, we have rights like, can you trade options? Can you trade naked options? Can you write puts? So it turns out men also have more rights than women. So they do trade more, but they have more rights. So it's not clear whether this is a gender difference or whether they have just more opportunity or different networks. And we need more work on this. The initial evidence is that they trade more or less similarly once you control for wealth and rights. Okay, wrapping up before we go onto the panel. Biases in China more or less mirror those in the West thus far in the research. The major difference is the gender ratio, which I find very interesting. I think looking forward, we're going to see Chinese investors, of course, using the market more and more as a retirement savings vehicle. Currently, they're under-diversified, and in this way, China and Hong Kong have big differences in the use of the stock market. The investors tend to choose local stocks, which hurts them. There is this folk wisdom out there, invest in what you know, which may be good advice if you're Peter Lynch and you gave it, but it doesn't appear to be good advice for the average individual investor. Now, for some of them, it may be, but for the average, just doesn't seem to be working. So currently, the choice of stock is far from systematic. We may get a discussion going on this about rumor buying on China. But I do know they lose about 1% to 3% when they put in their orders kind of on these days when everyone else does. And we do see this behavior affecting prices. We care about that a lot. Say you write a contract for your CEO to pay them an option based on performance. If prices are getting distorted in the market, the CEO's pay gets distorted, and we care about this. And then there are opportunities, obviously, to profit. Hedge funds can profit. Regulators can write new rules, and fund managers can offer, and advisors can offer better services. We have a study where we actually looked at a bunch of very smart traders from Ningbo who are profiting from this attention story in China. And these guys traded a lot. They were like putting down $1 million positions after events. And what was very interesting, it's a great study. We worked with the regulators in China, so the market security people, and they got us some great data. And the original thought was these guys are doing something illegal, but they weren't. They were simply taking advantage of people coming in on these limited attention days and trying to trade against it. Which is interesting because you had to think of a strategy to trade where you're not allowed to short. So what they were doing is when a price hit the limit, these guys would just buy up any shares people would sell them at the limit. And then they would sell them all at the open the next morning up to 3%. And it's totally legal. The regulators didn't love the behavior, but there wasn't anything. It was very smart trading strategy. And they were making a lot of money. They were making $1 million US a year, like a group of a few people. So it was, and this was a while ago. So it was a very nice trading strategy. You can profit from this. And it actually, the more they sold on day T+1, the lower the price distortion. So in some weird sense, they were actually making markets more efficient. Before we start the discussion, I was just trying to think, we may want to think about behaviors and groups of investors, like which group is most likely to exhibit a bias, which one's least likely. If we think of individual investors, we kind of have the retail traders. We may have day traders, somewhat more professional, or high net worth individuals who work with some of the people on the panel who get expert advice. If I think of institutional investors in the U.S., pension funds are often highly constrained and slow to react. Mutual funds slightly better. Prop traders are obviously there trading every day, and hedge funds are unconstrained and have a ton of smarts in them. And then if I think about securities, there's a big difference in trading OTC equities or listed equities from trading in the FX market. It's very hard to think about retail biases affecting the FX market or a government bond market, where the trade size in a government bond market is like at $5 million to $10 million. Some T-bills are $100,000 faces, and FX trades are also in the millions. A typical trade size is 10 million. So I think, and the FX market is hyper liquid, so there may be biases there. If they exist, they're only coming from super professional managers. And after all, managers are human, and they're subject to many of the same psychological issues that a retail investor. So it could be there, but it's going to be different to find. So with that, I've listed some of the papers we've written, and we'll just end with our little logo here. Thank you, and now we'll...
Thank you, Mark. I think you can take a seat here. And may we now invite other panelists to join Mark on the stage. So Miss Angelina Kwan and...
Do we switch?
Yeah, I think you can use this one. Sorry.
Okay.
Mr. George Chen and Mr. Alan Luke and Mr. Richard Mack. Thank you all.